Hi everyone, welcome to another Learn, Grow, Invest meeting. My name is Jermaine. I'm the founder of Learn, Grow, Invest. So here at Learn, Grow, Invest, we're a biblical-based, investment community. We focus on sharing our expertise and experiences with others. So we're all about learning about investments, personal finance, anything that you can invest in. We're definitely interested in learning and talking about it. So we host meetings every Thursday, like this one you're joining right now. And this is where we meet with subject matter experts and different persons within the finance space to share their expertise. And if you have any questions at any point, feel free to leave it in the comment below or in the live chat if you're watching us live. So today we'll be speaking about using debt to invest, commonly known as margin, leverage, margin loans, anything to that effect. And we are going to, just kind of discuss some of the pros and cons about it. Please note though, before we begin, that this is not financial advice. Everything that we share here is for educational purposes only. And anything that is mentioned is not to be misconstrued as advice. So please bear that in mind. So before I start, I'm going to say a word of prayer. Lord, we thank you so much for this day and everything that it has brought. We pray, Lord, for a meaningful discussion, one that we will learn and grow in wisdom and knowledge in terms of investing. We pray your blessing over the technology and everything that we will discuss. In your name we pray. Amen. Right. So, today we're going to have a very interesting discussion. So I'll share the story of how we got to this point later on, but let me just introduce our speaker. So Anand Chokovalu, his passion is finding simple ways to explain complex financial concepts. That's probably why he's been at the Motley Fool for a decade and a half, mostly on the editorial side of things, and that's why he spends so much time answering questions on Twitter. Trust me, this is absolutely true. Before Motley Fool, he gained his experience in the financial departments of companies ranging from startups to Fortune 500 companies. And we actually got to this point because he made a post on margin. So I reached out and we started talking about it. We met on Zoom to discuss it. And it was such a good conversation that we said, hey, let's just make a meeting out of it. So please, welcome our guest. Hi, Anand. How are you doing?
Good. Thanks, Jermaine. Thanks for having me.
Well, thank you for agreeing to meet with us. Before we jump into the conversation, I wanted us to just kind of describe and explain the scope of what we'll be talking about today. So in terms of, margin, we're talking specifically as it relates to investing in stocks. Some of the things we will say will apply to the crypto market as well, as I thought it would be interesting given, the correction we saw over the last few days. And we're really going to be talking about those two key areas. Is there anything else you'll be framing your feedback around?
No, that's exactly right. And yeah, any questions that come up, we're happy to answer them, right?
Yeah. So some of the things that we'll talk about here, the concepts may still apply to other, securities, but we're only talking about those two key areas, right?
Yep.
So, all right. So what's the best place to start? Let's kind of define, margin. What is margin?
Yep, you did a great job of explaining it early on. It's just a fancy way of it's a type of debt. It's a fancy way of saying type of debt. Specifically, it's a loan that you take from your brokerage account. Your broker lends you that money, and like with any debt, whether it's credit cards or your house or anything or a car loan, you need to know the gotchas and what all the specifications are. And there are special things about margin that we'll talk about as we discuss, kind of the gotchas that you need to be aware of.
Yeah. So I mean, so just like what person should understand, so margin is no different from a loan. Like if you should think of a bank loan, a standard thing, you'd have to first have an account with that bank. You'll first need to have some collateral or something. In this case, your portfolio is the collateral. So you use your portfolio and then you are assigned what's called a margin based on the size of that portfolio. So you can't, well, I'm not sure how it works fully in the States, and then maybe you can explain how margin works in Jamaica. You have maybe up to 60% of the value of your portfolio available as margin. So here there is some limitations. So your margin can't exceed the value of your account. How does it typically work in the States?
Yeah, I think pretty similarly. I think 50%, I think, is the max there. So to give an example, and each brokerage has its own rules around how much you can borrow and at what rates, and they differ by individual and account and all of that kind of thing. So yeah, if we say like 50%, so if you have $10,000 in your brokerage account, that would mean that you could actually have $20,000, because 10,000 is borrowed. 10,000 divided by the 20 is the 50%. And then we can talk about scenarios and stuff. But go on.
Yeah. Okay. So I mean, just the idea of that, it makes it kind of attractive, right? Because what most investors think about is, only most investors like to say, well, I don't have enough money, or I saw that trade, didn't get to take it because I don't have the cash. So it can be extremely appealing to take advantage of a facility which allows you to purchase securities without your own money. So, I mean, but, what are, well, let's maybe take a step back and kind of explain some key terms, surrounding, and just some things that persons would need to have in place. So, what are some of the things that they would need to be aware of, or what are some of the terms that you'd hear that, are kind of saying the same thing?
Sure. So maybe we'll talk about margin calls and what leverage is versus anything else, and kind of the trading. Maybe we can walk through a quick scenario of the upside and the downside of kind of explaining how this. So basically, margin, it's kind of like a fair weather friend. When things are good, it's really good, but when things are bad, it can be really, really bad. So let's take that $10,000 example.
Yeah.
Right. You put 10,000 in your brokerage. So that's what you need. That's the table stakes, right? And say that your brokerage allows you to borrow 50% and you take it all the way to the max. I like doing the logical extremes because it's more illustrative, and you can do anything along the spectrum. So now you've got 20,000 in your account instead of 10,000 because you've leveraged fully. So in an upside scenario, let's say things work amazing and your stock doubles. So in a no margin, you would have just had $10,000 in that account, and then it becomes $20,000.
Yep.
Fantastic. Now in that scenario where you take the margin, that 10,000, which you borrowed another 10,000, so you had 20,000, and that doubles.
That becomes
40,000.
Yep.
You owe 10,000 of it. So really, you've got $30,000, not the 20,000. So that works great. Where the downside scenario is, let's say that your stock collapses to zero.
Yeah.
Something bad happens, and it just goes down. That $10,000 in a regular situation, you lose everything you invested. That's the nature of investing. 10,000 becomes zero. In the margin scenario, that $10,000 becomes zero, but then you also borrowed 10,000, and that 10,000 becomes zero, and you still owe that 10,000. And then, by the way, brokerages aren't just lending it to you for free.
There's a fee. Yep.
Right, like anything. So typically, let's say, at this point with low interest rates, let's say you're borrowing at 5%. It differs by broker. So you also, even though you have no money and you owe 10,000, you also owe that interest. So that's the real danger. And then, we'll talk about it, but like mindset wise, then you start making worse and worse decisions, possibly to try to make up that money. So let's talk a little bit more about like a margin call.
Yeah.
which can happen during that time too, which is it's sometimes called a maintenance call, and it means, so remember on the broker side, they get the interest that you're paying, but they're also worried about I mean, their collateral is the stocks you own. So all of a sudden, you know, if your bank knows, you know, there are certain rules when you do a mortgage, they want to make sure that you have insurance on that house because they don't want your house to go to zero due to something
Yeah.
and not get paid. So a broker's worried about your stocks going down below where they can kind of take your stock as collateral. So when your stocks fall in value, your broker will ask you to add more cash so that you get back to that baseline level of equity.
Yeah.
So a lot of them, it's think 25% to 40%. You know, your initial one's probably higher because, you know, day one you might lose a little money. They're not going to margin call you right away. It's going to be,
Yeah.
it falls a bit. So let's say you hit those margin requirements. If you don't have the cash quickly enough, they can sell any of the shares to make up the difference. And by the way, this is the last time you want to sell a stock. You know, the whole thing is you want to hold through volatility. And when you're selling at the low, right, it's buy low, sell high, not buy high and then sell low, which is what you're forced to do. And actually, it's
Yeah.
even worse than that because the broker, at least in the US, doesn't even have to inform you and give you the option to put more cash in. They could at any time sell the stock whatever they want if you fall below the maintenance requirement to make you whole. You could see that in a scenario where, say, the stock's just free falling because there's fraud or something big
Yeah.
that
So
happens.
I'll just, you know, kind of, you know, lock into the point that you're making. So we're saying that there's an upside to margin, and would have explained that where, you know, you started with 10, you got a margin for 10, stock doubles, you have, you know, 30, which means 40, and you pay back 10. What we're talking about now is the opposite, you know, because persons don't really think about stocks going down, but it does in the real world, right? So what happens is that you would need to typically either sign some agreement to have that margin in place. And what that typically does is say to you, what that does is enables your broker to do what's called a margin call. That margin call is the right of the broker to do any time. It's not just when it's favorable to you. And it usually means that they have the right to sell the existing security which you would have purchased, and your entire portfolio which would have been used as collateral for the purchase in the first place. So if you have your stocks and you would have, let's say, used margin for an IPO, and the IPO drops 40-50%, you can have what's called a margin call, and that 50% would be taken from the portion of your portfolio that was used as collateral. So, I mean, there's this thing that I see some brokers do where, so I've used margin before, full disclosure. What I would do is be proactive and say, you know, so they have this list. Some brokers have this list that they would have for persons who are using margin, and they'll call you mid-month and say, well, are you going to add cash, or you're on the list of persons who are gonna, you know, be going through the margin call this month? Because with a margin account comes interest, so you have to pay interest monthly on that negative balance that you would have, because if your portfolio goes down, then you're going to be negative because you are already negative because you're using money that you didn't have. So that interest that you typically pay, some calculate it monthly, some calculate it yearly, and you pay that at the last day of each month, because the margin the fee is charged for the 30 days. What we're saying here is that margin call can happen anytime, and they don't have to ask you. They have the right to sell at their leisure all of those stocks that equal the amount that you owe them. All right, so that's kind of the picture that we're painting here. Right.
And one thing, you know, you mentioned the like stock going down 50%, because in my example, I took the logical extreme of 100%. But the leverage, right? That if you take 50% leverage and your stock falls 50%, you're completely wiped out. You won't have any money for the margin call, because that in that $10,000 scenario, that $20,000 becomes $10,000, but that $10,000 you owe. So 10,000 minus 10,000 0. So you'd have to get that money from somewhere else if you wanted to.
Exactly. Which is why you were saying they would ask you to add cash to the account. What I've seen as well. So the account that I had margin on, I was receiving dividends, and I'd set up a dividend mandate for it to go as cash on my account. And so that would just be applied to the balance. I could not withdraw cash until I had cleared that margin. So that's kind of how it works as well. So everything, until you are positive in terms of your account balance, you won't be able to do it. You in some cases you can still purchase additional securities depending on the amount of margin you have, but it really depends on the broker and the terms that they have. But just understand that it's just like a car loan or a mortgage. You can't do anything else with that asset until that loan is cleared, right?
Yep. But the difference is the car and the house. You can't. There are no margin calls, right? There's no. As long as you're paying your mortgage, you're fine on the house. As long as you buy something you can afford. If your house falls in value 50%, that stinks, and you probably can't sell it and move, but you keep the house as long as you're making the payments.
Yeah, agreed. All right, so I'm going to intersperse our conversation with some questions, right? So Richardo is asking if you think a beginner investor should use debt advances for their portfolio. Should they use debt at all?
My answer, and again, I'm not I can't give personal financial advice, but my general belief is no. Especially not beginning investors, because you're still learning everything about just the basics of stocks, and you're going to make mistakes. And the general thing is, hey, you don't want to be putting money in that you can't lose, and you want to make sure you have an emergency fund, and your expenses covered, and this, hey, if anything happens, you can afford to lose it. Ideally, you don't. You invest for the long term. But if you put it in margin and you lose more than you can afford to lose, because it also gets tempting. Even if you do kind of well, put more and more in there, and so like, let me give an example. So not only beginning investors, but professional investors and the smartest of the smart have historically had problems with debt and basically akin to margin. So there's a company called Long-Term Capital Management, which had, I believe, 2 Nobel Prize winners in economics. This is around the late 90s. And they levered up so high that I think there was a financial crisis in Asia. And basically it took the whole thing down, even though they were really smart, making good money when the times were good. When it was bad, it blew up. Bear Stearns and Lehman Brothers during the financial crisis and all the different Wall Street things in the US, that all and really throughout the world, that happened because of leverage. They were leveraging themselves up way beyond what they should have been, what made sense. And if you want a good kind of book on kind of Wall Street trading a little, Nassim Nicholas Taleb, he wrote that book, The Black Swan. Black Swan's a very rare but catastrophic event. So this was really popular around the financial crisis. Well, his first book, or the book before Black Swan, was Fooled by Randomness. And he talks about his time as a Wall Street trader, how the top ranked, what was interesting is, so you'd have, right, each, say you have a trading department of 20 people or 100 people or whatever. Those top ranked traders, right, they look amazing for whatever they're doing, right? Whatever their strategy is, and everyone wants to know, oh, what are they doing and how are they doing it? And they do amazing, and they get huge bonuses. So definitely the incentives are there, especially when you're not playing with your own money. You're playing with the bank's money. And so they do great for years and years. But inevitably, they'd blow up. You know, maybe it's in 3 years, maybe it's in 1 year, maybe it's in 2 years, maybe it's in 5 years. But because they're taking these kind of risks as a trader, and that's what margin does. It takes something that already is a, you know, a riskier proposition. You can do well by buying quality companies and holding for the long term, or buying good index funds, but you're increasing the amount of debt, increases the amount of risk, which can increase the returns, but it can also increase. And if you do 50 iterations, it doesn't end up good. If you do 2 iterations, maybe you get lucky.
Yeah, so that's one of the things we were speaking about, and I know that, you know, Nick Green, who joined us last week, was talking about like market and investor psychology. There's this thing where so margin gets tempting when a person would have made a few guesses or a few bets on the market. You know, some of their picks work out, and they're like, well, if I only had more money to make that purchase, I would have made, you know, X amount more. Let me just use margin because, hey, it's there for me to use, and they'll use it a couple of times, they do well, and then you have a situation like COVID that happened last year, and we're talking about the fact that in Jamaica there were, you know, places who were giving out loans for you to be able to take advantage of an IPO that we had out at the time. And so a lot of persons would have taken loans and margin to purchase that IPO. Then COVID happened. You know, thankfully we have this thing called a circuit breaker in Jamaica, where the market can't go below a certain amount. But the point is, a lot of persons, that IPO has never been at listing price, I think, in over a year. Maybe it touched it. Maybe it went to it came out for $1.41. I think the highest it went to is $1.39. But within the first, you know, month or two, it went as low as like $1.20, which I believe was, you know, maybe 25-30%. So a lot of persons would have thought that it would have done really well, you know, not planning for COVID. And as you said, there can be, you know, black swan events. You don't plan for them, and then now you have this loan or this margin that you need to pay. And it's very, very attractive, though. I've seen, you know, persons who speak about debt in general saying that debt is a good way to invest and build wealth. So what do you say to that, to those persons who say that it's a great thing to leverage?
Sure. I guess usually those quotes, they're not from so if you look at the best investors who have had the track records over history, they're pretty much to a person against it. So if you talk about Peter Lynch or Warren Buffett or Charlie Munger, I pulled some quotes. So here's what Peter Lynch has to say. So he's the guy who ran the Fidelity Magellan Fund for, you know, from maybe the late 70s to the early 90s, and he generated I think it was a 29% average annual rate over like 13 years or something, which is ridiculous. So to put that in perspective, the market does like 10%. Warren Buffett over 55 years has done 20%, which is ridiculous. Yeah. And he did 29% over a shorter period of time, like 13 years. So here's what Peter Lynch says about margin. When you have a family and a house and the market is going down and you're on margin, it's probably too much pressure for you to do the right research and the right kind of thinking to make good decisions. Charlie Munger, who's Warren Buffett's partner and pretty much equally bright investor, he says, Warren and I are chicken about buying stocks on margin. There's always a slight chance of catastrophe when you own securities pledged to others. The ideal is to borrow in a way no temporary thing can disturb you. So that would be like the difference between a house loan, with good money down, versus a stock loan. That's what I'd say to that. Because most of the time, the folks I hear quoted, they don't have nearly the track record. And this is again going back to that fooled by randomness Taleb example of, yeah, like just right now, if you go on financial Twitter, FinTwit, there are a lot of 1-year geniuses, right, who are just destroying the market because they're in high growth companies, and when high growth companies are in vogue. And I've got a few companies myself where I have to say to myself, well, no, this is the I'm not a genius. This is just the time we're in. Got lucky on this. Yeah, I had a reason for buying it and stuff. But what I want to hear are the folks who have been in the market 30 years,
Yeah.
who what they're doing and what has worked for them.
Yeah. So what I'm hearing you saying, it maybe suits a person who has an aggressive risk profile. If you're an aggressive investor, you may be willing to take that risk. But what I also hear you saying is that because there are no guarantees, you're taking that risk possibly at the sacrifice of your money that you could be used to taking care of your family or doing other things. So I guess it really depends on, I guess I would say that the way that I kind of meet that in the middle is, say, how are you using the margin, right? Because I see where it could be potentially attractive for those who would have trained themselves in doing short-term trading. So it's not, I see it as something that you should probably use cautiously. Meaning, I've had success stories with margin. I've had IPOs that I've purchased. It goes up 40 to 60%. I close out my position, keep my profit, and I just clear that margin as soon as possible, so that I'm not working with money that's not mine. And then I save that. I leave the capital. Well, I leave the profit in the market in the form of that security, and I leave that. And then at least I know that security is there, and I didn't pay for it. It was used. It was paid for by margin, if that makes sense. It was extremely risky, sure, but it was at the time a certain percentage of my entire portfolio. So it would have maybe represented like a 10 to 15%. But then, I would have also seen the situation that took place last year, and I'm like, well, that one didn't quite work out the way that I expected. And it's almost like you can't have guarantees. So anybody who says that they're an expert at using it, what you're saying is that you want to hear, from them in, 20 years or 30 years and see if they feel the same way. Right?
Yeah, my inclination is to, so I guess, the person I'm addressing is someone who wants to build their money over time and doesn't want to be taking the risk and want, that kind of risk, wants a good retirement. And I think what the other side of that is, if you're a pure entrepreneur kind of person who does not mind going, not only losing everything, but maybe losing more than everything, and are fine with that, and will figure out a way to get out of it over time and try again in the future, right? It's like, I'm not going and opening a restaurant. I don't want to take on that capital and lose it all potentially, but some people do. So if that, what I do want to, and I'm a long-term buy and hold investor. I don't believe that short-term trading generally works. And I think that also, even if it does, the taxes that you incur, at least in the US, are prohibitive. So that's where I'm coming from. So most of the people that I guess I'm talking to are the ones who are just like, look, I don't know, either beginning where it's like, look, I want to build a good life for myself, and I don't want to take unnecessary risk, but I want to build it over time. I think if you don't understand, because some people will use margin, and there'll be some really good stories about making a ton of money. I don't want the other person to say, well, that person just doubled their money, let me try too, without knowing knowing that there is real risk there, and potentially, especially when you don't when you're taking the when you're putting a lot of your own money in versus your total portfolio, that can get real dicey.
Yeah. So I mean, so it comes down to pretty much your experience as an investor, your knowledge of the company that you're invested in, and the asset that you're investing in, and I guess what your goals would be. So what you're saying is that the person who is a long-term investor, thinking about buying and holding good companies, margin is really, I guess most beneficial in a short-term perspective, because one of the things that you were saying on our call is that if you're interested, if you really love that company, you can just buy it over time, dollar cost average anyway, and in 10 years, 20 years, you being able to get more units now on margin is not really that big a deal, because in 10 years, 20 years, you can own the same amount that you would have gotten with margin now anyway. So margin doesn't seem to favor a long-term investor. It's more a short-term, maybe somebody who is interested in trading.
Well, I am against margin of all kinds. You're more into it. I'm completely against it. And I think my challenge on our call was, hey, if you're such a good investor, why do you need the extra boost of margin? Why not? You want as much time in the market as possible. You don't want that margin call to kill you, because you're such a good investor that you're going to win over time, would be my challenge.
Yeah, and so one of the things we wanted to talk about as well, look at how the markets would have been over the past couple of days, and I know there are some brokerages, for example, that will allow you to take out facilities to purchase stuff like crypto on loans or on margin. Those persons would have seen, I think, Bitcoin go from 64,000 to 39,000. In a margin situation, that's a really tough position. So that's one of the things we're talking about as well, where there are always events that you can't account for. You have to be sure that you're comfortable with that risk. So it sounds like it comes down to risk management, right? I see Xavier here asking a question. Xavier is asking, what about a portfolio strategy where you use the margin to buy a more secure asset like an index fund, but respective to your portfolio, treat it like a risky investment, maybe 5% your overall portfolio? That kind of sounds like what I was saying before, where when I use the margin, it wasn't a full allocation of my portfolio. So it was maybe 10 or 20%. But I mean, that's any thoughts on that question, Anand?
Yeah, I mean, I guess the index fund, right? It's still a stock. Stocks in general are volatile. Individual ones are more volatile than an index. But an index fund, I mean, 2008, you had indexes, and well, even now, if it's like a growth fund index in the last few months, you see tremendous volatility on the downside. To use that Bitcoin, it's not an index, but Bitcoin, just what you're talking about, like it fell, I think 20% or something like that yesterday at some points. And if you get that margin call on it and you have to sell at that low point, and then it snapped back a bit, and then you don't participate back in that upside, it kind of cuts you off. So I guess on the index fund, I guess it's all a spectrum of for me, it's black and white, that it just doesn't make sense. So using it in small quantities better than using it in larger quantities, but that and this is actually where those Wall Street firms, they get really in depth. This is like that long-term capital management stuff, where it's like, oh no, or let's take 2008. The reason the housing crisis in the U.S. happened was because you had AAA debt rated housing securities, mortgage-backed securities, And it turned out they weren't as safe as you thought, but they were rated AAA, so super, super safe. So that was actually that exact idea that, hey, on this, we can take crazy amounts of margin because it's such a safe security. And it turned out it was.
Good point. That's a very good point. Yeah.
So.
Yeah, interesting. So Chike is saying, I guess it would depend on the time horizon, and I agree, because if it is that it's a long-term buy, Xavier, I would just, it makes sense not to use margin, but instead to just dollar cost average, because if it is that you are receiving a regular salary and you get paid every 30 days and you buy some of that index fund every 30 days over 12 months, over 2 years, you'll have more or less the same position that you'd have had with margin, because an index fund to me is not going to have a great amount of growth really over the short term, unless I'm not, thinking about index funds in the right way. But to me, they're not really purchased for growth. It's more for stability, right?
I think, actually, I think they're, the market average is about 10%. Historically,
so, I mean,
it's a good growth. I think this last year has warped kind of what growth means to folks, but 10% is amazing because you're trying to beat inflation and then also gain on capital. Making anything more than 10% a year requires either just hard work picking, and learning about picking individual stocks that beat the market, or getting lucky, right? Like the Warren Buffett over that long period of time, 20%. This is a guy who started investing at age 11 and literally, reads all the 10Ks and annual reports of companies every year. Like, when he started, they were in big books and stuff. He'd read Moody's from starting with A, he'd go to B. This is the guy who would leave parties at his house. So you and I would be there for, well, not us, but we'd be at dinner with him, and he'd just leave and start reading 10Ks because that's what he likes to do. And he's done this for 70, 80 years, and he's able to go to 20% per annum. And so, but an index fund allows you to get 10% if you get a low cost one, like a Vanguard one. It's very, very like VT, which is the total world stock market index fund. I think that's a tremendous way to, it's kind of boring, living below your means, saving your money and investing in a good index fund over decades. But it's going to beat 90% of investors if you just do that, and it's zero work. You just buy that VT or something like it, or a group of them, and you just do it. And most people, I enjoy picking individual stocks and trying to figure it out, and the businesses and things like that. But if you don't, it's there, and it's a fantastic option for growing your wealth.
Yeah. So Richardo is saying that I mean, what he's pretty much hearing from the both of us is it's calculating risk or risk management. And yeah, I would say because just as how you would, the type of investor you are is based on your appetite for risk. So you are called, conservative if it is you have a very low appetite for risk. You're moderate if you take risk, every now and again. Aggressive, the riskier the better. So I mean, those are very simplified profiles, but that's the idea. So it's really that there are some persons. So I would say, though I am a person who is comfortable with some risk, I still do agree that you have to really think about what your investment objectives are and when you are actually going to need the money. If you're not going to need it in the short term, you don't need to take unnecessary risk in the short term. If it is that you have a goal in the short term that you could maybe use a facility like margin and you're willing to take the risk that comes with it, then that's your call. But if it is that you are investing on the long term, you are a value investor, you are focused 10, 20, 30 years from now, margin would not necessarily make sense, because though you are able to get more units in the short term, I'm really not seeing now the great advantage to getting a margin in year one when you're gonna wait 9 years to sell, right? Does that sound like it's something that you agree with, Anand?
I don't mean to be difficult. But yeah, I mean, the longer, I mean, even, when you think about 5% or whatever the percentage is
Yeah.
of borrowing, you have to be that much better, right? To earn the money over that time. But yeah, it gets certainly the longer term it goes out, because luck plays less of a factor, and it just evens out to what's going to happen over the long term. You put me in a casino and I play roulette and I pick red or black. I can absolutely pick it right once, but you make me pick 50 times in a row or 100 times in a row. I'm going to pick about 50 out of 100, and I'm going to lose about 50. And if you have me take leverage on that, I'm not going to have money to do the 100.
Yeah, and one of the things we'll note is that and I've been finding value in sharing this in our meetings, that we have to be mindful of what we see on social media. So persons may say, I'm using this, or I've used margin in this way. We have a tendency sometimes to only share our wins. So persons aren't going to say, I lost 70% on margin. Nobody shares those stories. We hear the stories that are good. So I bought Bitcoin at $10,000 or $5,000. We hear those stories. Nobody says I bought Bitcoin at 64,000. I haven't seen that post yet, but I'm sure somebody would have bought at 64,000 because it traded at 64,000. So and there's always a buyer and a seller. So just bear that in mind, and don't, with everything else, don't feel pressured to do something that you're not comfortable with. Don't act out of your investor character, I would say. So if you're not comfortable with the risk, it's definitely not for you. I also found the tweet that started this conversation, and I'll link it. I'll just retweet it now from our Twitter page. You're just kind of sharing your main points as to why you're against margin. So I'll share it again for persons to kind of see. But what are some of the main things that you would have said in that tweet? I don't know if you want me to bring it up for you, or you remember what you were saying.
I do not remember totally. I mean, I remember the main points, but by the way, as we're doing that, that is a great point. That people generally only share the good stuff, whether it's in all parts of life, right? But certainly in the financial world. A friend and I were talking about how you see a lot of the folks over the last year who have been bragging so much about their portfolios. A good percentage have been kind of radio silent. And you're like, wow, that person used to tweet all the time. Wow, they're just not tweeting, or they're completely off, or they're just going off on something else that's completely unrelated. I think, and I think that's something that we just can't get caught up in, right? Because it's so easy to get jealous of someone who's just showing like, hey, look, I'm getting X percent in this amount of time, or I doubled or tripled, and you're not sure whether they're calculating correctly or just some portion, like
they're telling the truth. They may be lying.
Yes, completely. Yes, you're right. Yeah. Yes, they could be completely lying. They could be calculating it in a different way. It's like when we talk about people's savings rates and stuff. Some people count. Some people don't even count. Don't count their house, or don't count their 401k. Some people not only count that, but they count other stuff. Do you count the employer match on a 401k or? But it's rough, and even if those were true, we shouldn't be focused on others. We got to play our own life, but it gets tough if you're out there and you just see value investors have had a really hard time over the last decade or so versus growth investors, and it's really hard for those folks to stay the course on what their thing is. But
so I mean, I can share what. So I didn't know about margin until about 2 years ago or 3 years ago. So it was introduced to me when I asked about it. So there was an IPO at the time, and I was really interested in it. And I was speaking to my advisor, and I was saying, well, I wish I could take advantage of this, but I don't have the cash right now. And he said, consider a margin account. And I said, what's that? He's like, well, margin would allow you to, and he broke it down for me, told me the benefits. And I was like, okay, cool. That sounds like a must win. And, I signed up for it. He told me exactly how to use it. And that's how I got introduced. So it's a word of mouth kind of thing where it can spread very fast. Persons can say, just ask here. I've even seen some brokerages advertise it, to say, hey, you can use your portfolio as collateral to purchase or to get loans, or, so it is something that is there. Not many people understand it. So what I didn't understand is really what the monthly interest would look like for as long as you don't pay that margin. So if it is that you keep it, it is calculated every 30 days, at least here in Jamaica. You have to pay based on that. And as you said, margin call can happen at any point. So if we're not familiar with that, so just like you would get what we call a repayment schedule for a loan, like a car loan or a house loan, you should find out exactly what you'd be paying per month, because there may be things about the process that aren't fully disclosed until you actually take out that margin, right? So, and persons may not appreciate the fact that literally after that margin is taken out, the broker does not have to ask you to sell those stocks, right? So those are the key things that would probably, want to say. I know Chike is, yes, read the fine print. Somebody said in the chat just now.
And always know the incentives, right? Because your broker was the one who introduced. Well, the broker has incentives for you to use.
Exactly.
Exactly. And by the way, I looked at the tweet. We talked about most of the things that I wrote about. But I'll say one thing is, one thing I wrote is like using debt to buy stocks means you're really confident in your ability to pick good stocks or whatever, and two, that those stocks won't fluctuate. And that's similar to why people lost their houses in 2008. And one we didn't talk about was Archegos, which was just in the last few months. They got that leverages debt was why they blew up. That was that hedge fund that all those stocks that they owned, they got. You're like, why did my stock fall 30? Well, because they were leveraged and they did that. So that's the most recent example of a Wall Street blow up.
Okay, and we were also talking about the situation with GameStop as well, because I imagine if there's a scenario where, as you said, that account can get to zero very quickly, and when it gets to zero, it's not like it's zero and you're done. You still have that amount that you would have taken out on margin that you will need to now repay. So it can, I mean, I think there are enough stories to share about the risks, but again, what we wanted to do here was really explain both sides. I think I would have done that, shared my perspective. I've had both good and bad experiences with margin. You don't touch margin at all. so that's good. I'll pause here to see if there are any questions. I think there If you're watching and you have questions, let us know. I'm seeing Wealth Magazine asking, what are the signs that you would look for when reading the financial statement of a company? So that's kind of unrelated, but I don't know if you want to share that.
No, absolutely. So yeah, it depends. There are different things for different types of investors. But one thing is, so you've got the balance sheet, you've got the income statement, you've got the statement of cash flows. So balance sheet, when we talk about a company having a good balance sheet or a strong balance sheet, you want to see that the cash position versus the debt position. We were talking about margin is leverage, right? How leveraged is the company? It differs by industry and things like that. But if a company has a ton of cash and not that much debt, that allows you to be in a better position where if for a year say you're going into the pandemic and all of a sudden you're losing money when you thought you wouldn't. Well, if you have a lot of cash, well, you can weather that storm. If you're really leveraged and you have a lot of debt, well, guess what? You go out of business. So that's one thing, and that's kind of a safety side of it. If you're looking for companies that are growing, right, you want to see that the top line sales are growing, and preferably by more than less, right? Then as you kind of go through, you can kind of look at three margins. You can look at the gross profit margin, which is how much you're making, the direct costs of whatever you're making, your sales minus that. And you can kind of look at that margin. And the more you have, the higher percentage that is. That's as you scale up as a business, that's kind of your power. Like if you've got 80% margins, you've got a lot of room to operate. If your gross margins are 20%, you don't have that much room for paying your employees, sales, selling and general expenses, any interest expenses. So then the second thing is kind of the operating margins, where your earnings before interest and taxes. You want to see that higher the better. But that's kind of the if you have a company that has more debt and a company that has less debt, since you're doing it before the interest and taxes, you can kind of compare the two and kind of their earnings power without that effect. And then the last one's the net income or the earnings. That's the bottom line. So that's the hey, are we making money or not? And then earlier growth stage companies, a lot of times they won't be. You have to believe that they'll make it over the longer term. More mature businesses, you want to see that money coming in. And then we talked about that third statement, the cash flows. You kind of want to compare what the income statement says for earnings with the free cash flow that they have, and see what the differences are, and kind of see. So, for example, something like a company that gives a lot of stock to its employees, they can that doesn't show up on the cash flows because you're not giving out cash, you're giving out stock, but it will show up on the income statement. And kind of seeing that and seeing, if you've got a company that's just giving away a ton of stock to employees, well, that dilutes you as a shareholder. So just stepping back, ideally, right, you want to see a lot of growth if you're into that kind of thing, and reasonable margins or profitability. Those are the first things to look at. And nothing's just a absolutely versus not. Like you look at a company like Amazon, which has grown for decades, and they purposely spend down their money so that they're not making much profit. But you have to understand that and listen to their argument and believe. Are you saying, well, okay, yeah, they really are investing in making their business bigger, and they're showing that because they're growing the top line? Or, well, they keep saying this, but they've actually shrunk sales over the last 5 years. So do I believe them or not? So a lot of it's kind of a detective game of you're trying to whether you believe the story or not. But the best thing to do is just go. The companies will give their press releases out, and just read them, and read them over time. Read their competitors to see if they're saying different things, because one will say, "Oh, it was a bad winter. We did badly." And you're like, "Well, that's cool, but this other company says it was a bad winter, but they doubled their sales."
Exactly. Yeah.
Why is that? Anyway.
Yeah. So the only thing that I'd add to that is that I look at financial statements as, well, they are historical data. So you want to kind of think about where the company is headed. You want to think about the industry, as you said, the competitive landscape. And I also like to look at what I call, intangibles about the company, because there are some things that the company might be invested in that is not gonna, show great results now, but maybe 6 months, a year from now, 2 years from now, you there are things that the financial statements won't show, is what I'm saying. So it's, everything is not found there. I know that sometimes we can use ratios to say that this company is the best thing since sliced bread, but there are other things that you want to invest in terms of research for that company, so that you make an informed decision, right? So, Chike has joined us too. Chike, I don't know if you want to share your thoughts about the whole, margin situation. I know that, well, let me not jump the gun. What do you have to say about margin?
Well, I err on the side of Ananda as well too.
You're outnumbered.
Yeah, yeah. I am not about margin at all. I've never tried it. Don't believe in trying it. I
Come
take
on,
your
man.
point, I'm sorry. I take your point where you said, Jeremy. I use my what I run by the principle of, or one of the principles, I should say, of Robert Kiyosaki. And that's basically simply the BI quadrant. So everything I earn as quickly as possible moves to everything that I own, which is I. I'm not even moving to the business side as yet. That's coming, but it's mostly about the investor side, right? So I am focused on my savings rate. I am focused on my spending rate, and every single year I try to improve that. When I started off with the 10%, and I'm now at anywhere between 40. I actually hit 50% very
Wow.
recently. And that was a one-off, but it was wonderful to see, right? But there are a lot of factors about how I was able to hit that 50%, by the way, as well, too, right? So, but it's still, I take those points very seriously, because the topic also is not just about margin loans, but we were also talking about debt. So
Mhm.
I personally, I'm not against taking a margin loan, and I'm also not against taking debt. But personally, I feel that you should take on only what you can manage. So I'll give you a good example of, it's more on the debt side than on the margin loan side. If you have the capital to basically make an investment, but it is not feasible to put up your own money, for or to say lock your money away for 4 or 5 years, right? If you know you can comfortably pay the interest, and that's what Xavier, that was my response to Xavier around that. If you know you can comfortably pay the interest, the fees, and the requirements, for that period of time based on your time horizon of the investment that you're doing, then by all means, why would you lock up? Say, for instance, you have in US dollars. Say, for instance, you have $100,000 to lock up. You don't need to. If you can get that, so for debt, if you can get an unsecured loan for $100,000, and you don't need to lock up, you have capital layby, you can take the loan, right? Or you don't, or should I say, you don't actually go for the $100,000. You go for a little bit less so that you're covered. I always believe in not going, and you said it as well to Jeremy. We go up, we don't go exactly to the point of what our capital we hang our hat at.
Yeah.
We go below that so that we have cushion, right, to go forward. That has been my principle. That's been my philosophy. That's what I've been doing from inception of my investment strategy. Um, does it take longer? Yes, it does. Because it's not risk. Again, the thing we're talking about here is risk management, right? With greater risk being taken, yes, there is greater reward to be expected, but also just the same way, there's greater risk for blow up of, as Anand said, you can lose your shirt, or more than your shirt. Maybe you lose everything, right? If you think you can handle that, by all means, go ahead. Those who have met with the bad side of that fate have not fared very well, and it's an arduous uphill task. I'm currently reading a book, the 10 pillars. What's the name of it again? 10 pillars. 10 pillars of wealth.
Okay.
And the person, you know, my thing of get rich slowly, right? In terms of, I am about learning. I started with get rich slowly, basically as the principle, but I'm very open to different strategies. So this person comes and completely blows it out the water. He goes, yeah, this get rich slowly strategy, you can do this, but you're going to take an extremely long time, and you're more than likely going to end up only having your money to be able to spend it in your retirement. Now, while I appreciate what they're saying, the strategy that he's on is get focused, get focused on a business, not necessarily a business like, for instance, opening, as Anand said, opening a restaurant, which is extremely risky. But for instance, we're in the period of the digital age. So you open an internet business. You open, his description was that he was basically getting ad revenue. And he did a particular type of business which was giving him ad revenue. And all he basically went on to do was his strategy was, how quickly can I clone myself so that I can be getting ad revenue even when I am not doing anything? So the money just keeps flowing like it's on top. I get that, right? But it takes time. So he said, what are you willing to risk? You're willing to risk your time for the greater payout later on, right? So he was decoupling the whole thing of time versus money, because we always say time is money. He was like, no, separate the two. Time and money are two different things when you're going, dependent on where you're starting and what is your objective. So for me, again, coming back to the topic at hand, I'm not averse to debt, but I am averse to taking on what more than you can manage. So smart debt is my thought process. If
Okay.
if your time horizon allows you to recoup that and easily and comfortably pay the fees and everything until it's recouped, by all means, go ahead and do it. Otherwise, do your planning, do your homework, do your risk management before you step into something like that in any form whatsoever. That's my view on it.
Yeah, yeah. I'm being reminded by Xavier that we focused a bit on margin, but we also mentioned debt and investing. So he's asking if we can talk about how and why cash-rich companies use debt to finance new or existing operations. That's interesting. Anand, do you want to take that one first?
Sure. So I guess it means like I assume the capital strategy of a company, like what's the right amount of debt. Yeah, I remember learning about that. You know, like in school, there would always be, in college, it would be, you know, in the accounting classes, it'd be like, well, there's an optimal amount, and so I think it really depends. So like, for example, I think it depends on the industry. So if you've got a biotech startup that has a binary outcome, most of those are super cash rich. And same with a lot of tech startups, super cash rich, because they know they're going to have a burn rate for years before they have even any sales to even, you know, we're talking about different margins. It's pre-revenue, no sales. So you need that cash hoard to just kind of do what you're going to, you know, to build what you're going to build. Once you're more, if you have something like a utility, on the other hand, that, hey, you're in the U.S. at least, it's government regulated, and you have a pretty much defined level of money that's going to come in. You take on a ton of debt because you're kind of, you know, our electricity company isn't going to go. We need the electricity, right? And they can take on that debt, and they know that the cash flows are going to be regular. For companies that are somewhere in the middle there, yeah, I mean, that's kind of the thing. It's just like we can take on leverage and kind of boost our return on equity for companies. Companies can do that, but the cost of that is, if their cash flows ever falter and their business model isn't as stable as they think it is, well, then they can either go bankrupt, or they might have to give float new stock as their stock price is at a low point, so they dilute their shareholders, or they have to take on debt at a bad point, which at that point, instead of paying 5% on their loan, they might have to pay 15% because they're a bigger credit risk, or it's in the credit cycle. that's more locked up. So it's a risk and reward element. For
Yeah.
me, it's something that I think about versus the upside of the company. Ideally, it's a factor, and you got to factor that in. You don't want to ignore it completely. You know, two companies that are the same, but one's has a lot of debt, one that doesn't. You want to kind of factor that in the scenarios that
Yeah.
there's some downsides.
Yeah, agreed. So I look at it even on a personal level as well. There are some situations where they would say, if you have a certain amount of cash, but you want to, for example, buy a car, don't use your don't use your cash to buy the car. Take a loan instead. You pay a little bit each month. I mean, a car may not be the best example because there's always a debate as to whether or not a car is an asset or not. That's not the point. The point is you can keep your cash, take the car out on a loan, use that cash now for investing activities or for operations or for whatever. You pay out a small amount each month, and now 3 years from now, 4 years from now, you may choose to sell that car, clear that loan, but you would have leveraged that cash that you have for the first few years. You want to add anything to that, Chike?
So this would be basically a follow-on then from basically what Wealth Magazine had asked with financial statements. So Xavier, I like the discussion about, or the question asked about why cash-rich companies would do it. It's simple, in my opinion. Sorry, they know how to leverage debt, and that is easily looked at if you look in their financials, in their balance sheet, and so forth. So the amount of assets that the company has. If they have a huge balance sheet that has, if they were to wrap up, if they were to need to wrap up, they have a lot of equity. Also, the fact of the matter is there's a calculation. I can't remember it now, but I did actually learn this from you guys, from the Motley Fool section. There's a calculation that they do about how long it takes if the company is over leveraged. They need to be able to pay their debt back in a certain time frame based on the amount of assets that they had. Don't quote me. I just can't remember the calculation now and specifically what it was.
Like a quick ratio or like current assets or liabilities.
So, right. But it was specific more than the current ratio. It was
quick ratio.
There's quick ratio, current ratio, cash ratio. But
there's
it was
a cash burn rate.
I think it was a cash. I had to do something
like the amount of cash you have, and then how much your losses are that you have like 5 years of.
Right. If they've already done those calculations, then they know that they can leverage this accordingly, and they can then put their cash that they keep back to work later on for something else. And it really goes down to, as you just said, Jeremy, back to the simplistic of thinking about yourself. If you don't need to use the particular, if you have the opportunity to take out debt, which is this now would be good debt, you have the cash to cover the debt, but you don't need to tie the cash up, right? And you're being offered the ability to
because there's this thing called opportunity cost.
Opportunity cost, right? So if you're able to cover it, and it can be a side just in case it needs to be deployed for something and so forth. It's the same thing on the scale. It's moving from the individual to the business. They're going to do the same thing. The really good businesses, which is why I love to look at, and you know me, I love to look at cash flow for businesses. That's really where I like to start. Assets in the balance sheet is one thing for sure, but that's, in my view, that's where liquidation is coming into play. Like when the company needs to wrap up and stuff like that. That's fine. Certain assets you can't sell that easily. You can't sell long-term assets. You can't turn that over in 12 months. You can't. You need to have something that is more liquid than that, right? So for me, I love to see how much cash the company has. And more importantly, I like to see how much cash the company has in comparison to their sales. So the indicator I love to use is actually on the cash flow statement. Well, a combination of the cash flow statement and the income statement, which is free cash flow to sales. The higher that formula threshold percentage is for me, I have found, and it has been shown, because this is what you guys do as well too, and Motley Fool does the same thing in terms of how they look at that. I've seen that before. The investors podcast as well I've seen all of the value investors, let me say it that way, the value investors, because it's what Buffett does. They're looking at that kind of info. And when they find companies that are cash rich, it's normally because when it's compared to their sales, they just have a ton to be deployed. And as I said, Germany, if you remember when we discussed this back in the day about when the pandemic started, I said I was looking for companies who were cash rich in that term, in that way, because they either can ride out the storm or deploy cash to take advantages of opportunities other companies cannot do because they don't have that capital, and it came out to play. That's where I look at.
Yeah. So we just for context, and so we used to meet in person as an investment community. So in February 2020, we met and we were talking about, no, I think when COVID was first announced, I think in China or some country, it wasn't in the Caribbean or the US as yet. We were saying, just in case this should come here, just in case it should be really bad, which companies can we look at that can weather the storm? We didn't think it would be as bad as it was, but we're like, okay, which companies would we invest in that, just in case we have to close down, just in case we have to, put in certain measures. And we actually outlined some companies locally that were good to look at, and that's what we used as the measurement over the next few months. So it was quite interesting to see that we're able to make that call. So yeah. All right. So Chike, we have one question for you. Xavier is asking, are you going to use leverage to buy the Bitcoin dip? Are you going to use leverage to that?
No, I'm going to use the upside of the other coins that I have that perform and come out. Yeah, we're gonna do some technical analysis there. Since all crypto is technical, it's not fundamental. So
that we won't go there. Anand, do you invest in cryptos at all, Anand?
I do have some. I started last year, and bought some of the big ones. And I'm a hodler. I just hold, and I'm not doing transactions or anything. But yeah, no, it's the reason that I bought in and fairly bullish on it just in general is I just think it's one, especially once the well, I like it for diversification, one, and then two, as the year has gone on, so many more major financial institutions have signed on to, you've got the big banks and Square and PayPal, Tesla occasionally allowing you to buy a car with it, and different companies holding say Bitcoin on their balance sheets, and then with NFTs rising, Ethereum's kind of use in that ecosystem, and crypto just whether what the price does over time. I mean, that who knows?
Nobody knows.
Yeah. But I feel like it's a thing, and the larger ones with scale have an advantage over the other ones.
So all we'll say. So we do plan for our viewers. I will say we do plan to cover cryptocurrencies in depth soon. It's just not time yet. What I will say is that it amplifies everything that you know about the stock market. So with cryptos, whereas for a stock, positive news will send it maybe 5%, 10%. For crypto, positive news will send it 100%. For negative news, now it's the same thing. Where a negative news for a company, you may see a 5%, 10% decrease. For crypto, negative news will do what you saw the other day. So that's the only thing I'll say to caution those who are new. I agree that it is good for diversification. That's actually why I have some as well. But I would say be careful at the price that you buy, because there's no way to know the bottom. There's no way to know the top. Find a price that you're comfortable with. And as we were saying before, this is one of those situations where you definitely want to be prepared and be calculated in your decision, because as much as we're talking here now, Bitcoin could be 100,000 tomorrow, but it could also be 10,000 tomorrow. Like
Correct.
that fact is a scary thing or an exciting thing, depending on who you speak to.
Indeed.
So that's all I'll say about it for now. But we are going to cover it in depth.
The only thing I want to add, there's only one thing.
Mm-hmm.
People are worried most persons worry about the volatility.
Mm-hmm.
The volatility of cryptocurrencies, in my opinion, since we've been looking at it and investing in it, is smoothened out over the long term. With this same issue that has happened here over the past few days, that happened, a friend of mine, he had called me because he was worried when he woke up in the morning or what happened, and I had to say to him, take a step back. It's like with all investing, take a step back, breathe, and assess your situation in terms of where you are at. At what price did you buy the particular coin that you own? All right.
Mm-hmm.
And I said, you are nowhere close to where you bought the particular coin. So Jeremy, you remember you made the comment that this is where everybody's going to learn about taking profit. No, the truth is, if you're holding it for the long haul, because you believe it's going to an exponential height, etc., or whatever your get out point is,
Mm-hmm.
right? Your profit taking point is. What you just said is the most critical point. You try to buy at the lowest point. So henceforth, as far as I'm concerned, pullbacks, extreme pullbacks, because volatility is the best thing about this, is the time when you get in the most at that point in time, if you were getting in. And then, so what you're trying to mitigate is when it drops again, based on what I've been learning, right? It doesn't normally go below its last point. There are higher highs because inherently, well, listen to this argument. Inherently, all investments are bullish because anything that comes out, any company that comes out, etc., the expectation is what? It going up. We're not expecting it to come out and go down. We're not expecting it to come out and crash. We're not expecting the company to come out and go bankrupt. We invest in things because we expect inherently we are bullish on them. It will go up. That is our expectation. That's not what reality does, though, right?
Mm-hmm.
Henceforth, why? For companies, for stocks, for investments and securities, valuation is key and doing your homework is key. For cryptocurrencies,
but Chike, the problem is with cryptocurrency, so
no,
far it is
getting to
not
that.
about valuation.
So
It is
and
it is
I was getting to that with cryptocurrencies, and I said that just now
Mhm.
earlier on. It is technical. It's on the technical side. It's just about price movement and about who's feeling what. But as I said, when we get to the discussion about cryptos, I will explain my case better. But to say what I
Yeah.
say, my belief has always started from a point, and you know this, of use case. And then
Mhm.
I try to connect the dots in how that use case is going to change industries. For instance, let's look at MasterCard payment systems. We're in the digital age, and payment systems has now come due. And who's
Mm.
one of the biggest beneficiaries of that? Check Mastercard. And what has Mastercard been doing? Whopping up all over the place, basically trying to ingrain themselves. And they've also done in the back end. They've taken on blockchain as well to ensure that their processes in terms of transactions are faster, right? You just have to connect the dots and know exactly, well, you try as best as possible to do as much research as possible to understand what you're investing in, whether it be crypto, it be a company, bonds, options, futures. You need to understand what you're investing in. The more information you can find, not to the point of paralysis analysis, but the more information you can find and the more information you understand, then and only then I believe you should be making any decisions to put your money at risk, because each one of them is a risk to do something. It could be conservative risk, it could be extreme risk. It doesn't matter. It's still a risk,
Mhm.
right? So that's my view on it.
Yeah, and I mean, as and well, I won't speak for Anand. Anand, anything else you want to say about your cryptos before we close out that point? We'll just kind of recap afterwards and then close out.
Sure, real quickly, crypto is, hey, if you're new to investing and just starting, that's probably not the first thing to buy, right? Index funds or quality companies. There's no, GK was talking about free cash flow yield, the free cash flow over sales. There's none on crypto because it's just,
nothing.
What I'm talking about it is, hey, you've got a full portfolio and a little for diversification, like 1% type of thing, not going crazy. But
yeah, I think that's a good point to leave it at as well, because it's, if you don't understand the idea behind it, what drives it, we definitely wouldn't recommend that you invest in it. So yeah, definitely agree there. All right, so final thoughts, Anand, about margin, debt, anything that what would you recommend for somebody who is considering that?
Well, my personal view is just scrub it from your mind and just don't do it. That would be my, personal advice, my personal philosophy. Just
okay. All right, so what I would say is that just like with anything else, you want to understand it fully first. So get all of the information, and there are many things to consider here. You have, the margin, you have, loans that you could take to use for investments. I would say it all depends on the situation. Understand there are no guarantees, and understand that you may think you're right, but you could very well be wrong. Once you consider all of that, the best way to learn, I think with investing is to lose money. When you lose money, the lesson is, if you don't lose money, you don't learn as fast. So if you take a shot with it and you fail, that will stick. If you take a shot and you win, you may do it again and go higher and go higher.
Take more risk.
Yeah. So either way, you'll learn, right? So that's what I'd say. Chike, you have anything to say regarding that?
Just 3 words. Do your homework. That's it.
Okay, cool. Fair enough. So if you want to learn more about margin, ask your broker. Ask them if they have a margin facility, how it works, what the fees are, what the interest rate is. What does that mean in terms of your account, just to understand how it works and what you should do, because it's good to be aware, right? It doesn't mean that you have to use it, but it's good to be aware of it. All right. So Anand, thank you so much for joining us. I think that we're definitely going to talk again about, some other things. I want to talk to you specifically about your concentration, your lack of concentration in terms of your portfolio.
Right.
I definitely want to talk to you about that one day. So we'll set that date. But guys, Anand has over 100 stocks in his portfolio. And it blows my mind because I don't know how, but we'll get to that at a later date. I would say
the little bit that still beats the markets.
Chike, stop it.
but Brian, I mean the concept of you guys do, Anand, is holding at least 15 stocks. I subscribe to your newsletter. The last one I got stated, you find 15 at the minimum level, find 15, and you correct slowly, and you must hold them for 5 years. So it's hold for the long haul. Mm-hmm. So you find 15, hold for the 5 years at least, and then you correct slowly each one that drops off of performance and replacing it with something else. So I can understand how Anand got to 100 odd stocks.
So I'll retweet that thread as well, because he did give context, because I was wondering if it's 100. Well, I really don't want to give it away, but I'll retweet it just now for those who want to check it out. So follow us on Twitter and you'll see it. Follow Anand as well on Twitter. I'll share his handle in the description of this meeting. So Anand, thank you so much. We'll definitely want you to join us again soon, and we'll share your links so persons can reach out to you.
Thank you both. I had a really good time talking to you and to the folks asking questions.
Same. Thank you.
Talk to you soon.
All right.
Bye, guys. Bye.
All right. So Chike, we're actually going to be going on Spaces in a few minutes to continue this discussion with our friends Ryan Strawn and Simon. Exactly. That's going to be a very interesting conversation. So yes. I thought, one of the things we're kind of testing, and we'll see how it works out, but when we have these meetings, persons from the audience will really get a chance to speak. Spaces will allow us to, invite persons in as speakers and they can share their thoughts. So we're trying to get a little bit more engagement from our community. So if you're on Twitter, follow us at Learn, Grow, Invest. We are going to go live on Spaces in 5 minutes. And we have not actually, settled on a meeting for next week yet. But as soon as we do, it'll be posted. More likely by Sunday, we will decide and we'll let you know. And so, guys, we want to thank you so much for joining us. Please also subscribe to our newsletter. We try to do a recap of the meeting that we have. So I'll do a recap of tonight's meeting in form, send it out to those who are subscribed to our newsletter. The link is in the description as well. Or if you go to our Twitter page in our profile, it will show our link to the newsletter. We also have our shirts available, our L.E.A.R.N, Grow, Invest t-shirts. So persons have been showing their photos of them, representing L.E.A.R.N, Grow, Invest. So pre-order is available for those shirts right now. So please take that. And for everything else, we will see you in the next meeting.
All right. Good, everyone.